Hi, welcome to Numerics Video Blog. I'm your host, Jim Jockel. Fed funds back in the news again this week against a disappointing jobs report. To talk about this today and other trends in the global economy, Udi Sella, Vice President of Business Development for Numerics and EMEA, is joining us from France. Udi, how are you, sir?
Very well, thank you, Jim. How are you?
No complaints, no complaints. So clearly, jobs numbers came out, not what we were expecting. What is the near-term implication from the perspective of potential rate hikes as it relates to the Fed funds?
Yes, so Jim, the report came out last week on Friday. The market was expecting 204,000 new jobs. Eventually, the number came at 160, and that was a major disappointment for the market. As a result, immediately the market is now discounting one rate hike, so instead of two, just one. And instead of June, now the market expects it to come around September. Some speculate it will be July. I personally think it will be on September.
Yet, but amid the across the world, we're still seeing some rates going down. I think most recently the Australian dollar has also seen a dip in yields.
Yes, of course, that is very true. I guess Australia is still sobering out from the end of the commodities boom, and therefore, weaker demand from China, because China is probably the biggest partner of Australia. As a result, less Chinese investment in Australia, and the economy is slowing down. And in order to try and boost the economy, the Australian Central Bank has actually lowered the rate last week. I think it's now 175, the lowest level historically. And as a result, the Australian dollar weakened from levels of about 76 cents to the dollar to 73.
So the question I have to have, and this is it seems to be one of your favorite words lately, is inflation. So obviously we're seeing slower growth in Australia due to China. China's been coming down a little bit. Job numbers not performing in the U.S. Where is your perspective and your fear as it relates to a potential inflationary environment?
Yeah, so until like 2-3 years ago, we were fighting the previous war instead of the new war, which is really raising demand. And of course, the fear is that people delay their consumption decisions because they believe that in the future it will be cheaper to consume. And of course, there's more fear, if you like, in terms of job security, etc. So people are much more reluctant to consume. And the fact that we have historically low yields across the board, a lot of people were using basically cheaper funding for real estate, etc. But now it's like someone is almost overdosed. The impact of the low rates doesn't really transition into stimulating the economy, and to that you need to add technological changes, which make many job cuts redundant. We even see that in our industry, where in some places machines replace people. In terms of, for instance, in market making, or in investment decisions like algorithmic trading.
So staying on investments versus consumption at this point, because clearly there's going to be an ongoing challenge in consumption, extension of credit is being challenged, but on the investment side, where are we seeing the monies, right? Given the rate news and unemployment, we're not seeing a flight to quality as it relates to UST. Negative bond yields are continuing to challenge performance, and equities are still kind of on the upside, but there's always talk about a bubble. So where's the money going right now?
So I've been following a bit because that's obviously a question we all ask ourselves. One thing is in real estate, right? If you look at prices in the big centers like New York, London, even we mentioned Australia, so Sydney, right? You see money coming out of China going to Hong Kong. That's one thing. Right? Another, you mentioned equities. One of the things I look at equities or ETFs that look at what they call dividend aristocrats. And if you would look at, if you would compare the S&P to the dividend aristocrats ETF, you would see that the premium or the alpha that this generates. And of course, people, money being part, those that cannot take even minimal risks, they basically invest in yields. Even the credit spreads have tightened again. Spreads were opening with mostly, credit related to oil companies, especially in the U.S. And even there, we see a comeback.
So I'm gonna pin you down a little bit here, right? So on one side of the coin, we're concerned as it relates to job security and investment, yet we're still continuing to see rising real estate prices. What is the concern as it relates to another bubble?
I would well, it depends where the money comes from. A lot of money, which is, let's say, investment money, which is known, declared, etc., that does go into those legitimate, real estate purchases, right? But you have to look for it. One of the things that people do is the luxury prices go really higher, and at the same time, middle class citizens of, let's say, of London, for that matter, getting pushed out. So, what they call gentrification. And in China specifically, there is an issue. There are tighter controls since the central bank had to intervene over the last few months to support the local currency, which was yuan, which was weakening against the dollar. So the way people found a way to overcome currency controls is by purchasing and invoicing out of Hong Kong. So this money is also being used to purchase real estate in Hong Kong, and you can follow the process there too. They want to stay there. Same in Vancouver, for that matter.
So my key takeaway, Udi, from you is that there's no new Tesla under the Christmas tree this year. Udi, I want to thank you so much for your time. And of course, we always want to talk about the topics that you want to talk about. So for the first 5 people who shoot me an email, we want to see you sporting around a nice Numerics hat this summer in support of the Numerics video blog. Shoot me an email, and the first 5 people will send you a nice hat. And of course, follow us on LinkedIn and on Twitter at NX Analytics. Udi, thank you so much for your insights, and I hope we'll talk soon.